Hey guys, David Robinson here. Welcome to another episode of the Lead Sponsor Podcast. As always, really excited about our episode today. We've got a great guest coming on the show. This is an individual that focuses primarily on self-storage syndications and targets value-add facilities in key markets throughout the United States. His company has acquired 70 projects to date, totaling 2,500 units and just over $500 million in self-storage, and half of that portfolio being acquired in the last roughly 2 years. We talk about the three big reasons they chose self-storage over other asset classes. We also talk about the most critical metrics they look for in a strategic market. We also talk about a strategic decision they made, which he attributes to their incredible growth in the last couple of years. So I'm really excited about this episode. I think you're going to get a ton from this conversation. And without further ado, Mr. Ryan Gibson of Spartan Investment Group. Mr. Ryan Gibson, welcome to the Lead Sponsor Podcast. Appreciate you coming on.
Thanks for having me. Appreciate it, David.
Yeah, my pleasure. So we always like to start off, if you could, tell us a little bit about your background and how you got into the self-storage space. Well, we'll just say the real estate space.
Yeah, so just always been entrepreneurial, and fortunately was in Washington, D.C. at the time, and bumped into my neighbor who we decided to flip 4 houses on that street, start a company that developed real estate. And we got really sick of doing residential, and we liked self-storage because during the last 4 downturns in GDP, it held steady and was one of the top performing asset classes and really proved out to be recession resistant. We also wanted to build a big company. And in order to do so, we wanted to scale, and we saw the scalability characteristics of self-storage and how we could have an asset that was easy to own, easy to maintain, and easy to evict. And so self-storage was just a natural fit on something that does pretty well during downturns, or sorry, pretty well during good economic times, but excellent during downturns.
Love it. So a great little brief bio there and lead up to, how you guys got started. So you met your business partner. He was a neighbor. You guys got into flipping homes early on. I believe he was a builder by trade. Is that correct?
No, we actually both had very little real estate background. My background is actually as an airline pilot, and I flew the most of the Boeing products, 737, 75, 76, and for a major airline. And Scott's background, my business partner, was actually served in the military. He's a Army vet, served in Iraqi freedom. And so his background really had less to do with real estate and more to do with leadership and project management. And so kind of my entrepreneurial spirit and his, vision and leadership that he really brought to the table was just a potent recipe for, kind of making a big company and really buying a lot of, good performing assets and, growing Spartan. And, when we met with one another, we kind of realized our strengths and weaknesses, and it was a great match in that respect. A little later on, we met with Ben Lapidus, who runs the Best Ever Conference that you're probably familiar with, the Joe Fairless.
All right.
And Ben is our CFO now, one of our partners as well, and he had a really strong background in financial analysis, underwriting, etc. And his background really helped the partnership kind of become really strong. And we really kind of covered all of our strengths and weaknesses through that. So Scott did build houses during college, but outside of that, he wasn't really a real estate developer per se, but familiar with how to swing a hammer.
Got it.
Yeah.
So you guys decided to dive into self-storage. Now, you mentioned some of the reasons you wanted to be able to build a big company. You wanted some scalability. You wanted something that was, fairly low maintenance, so to say, as it relates to the management and operations. all of those characteristics could arguably be applied to also multifamily mobile home parks, which are, three very, very common asset types that you see invested in commercial real estate. Anything in particular? Was there any moment in time, or was it just the fact that you guys did some research that led you down the self storage path? Did you have a mentor? Did you have anybody guiding you down that path? Anything unique that caused you to go self storage versus other asset types?
How long does it take to evict your tenant?
It depends on location.
And what's the worst?
I mean, it can be drug out years in some instances, but here in Utah, it's fairly easy.
What's the best case scenario on timing?
You're probably 60 days.
So we can have anybody out pretty much in 30 days, and any rent they don't pay, we can auction off all of their belongings and recoup any lost rent that we've had. We had no evictions, moratoriums. We had no government restrictions put on us on who we couldn't evict or during the pandemic. We can pretty much get out non-paying tenants within 30 days and generally recover the losses that we get. Now, the next thing is what happens when that tenant gets evicted. That apartment is probably a disaster when you get in there, right? There's probably a lot of things that you need to do. You probably need to spend anywhere between $2,000 and $7,000, minimally to carpet, paint, drywall, sheetrock, whatever it might be, change locks, etc., to get that tenant out of there. We have an empty steel box, so there's nothing to do when a tenant turns over outside of sweeping it out. So when we say easy to evict, it really is easy to evict. Scott likes to joke around that, nobody cares about grandma's dresser. But what the government does care about is making sure that people have housing. And so, we're kind of flying under the radar, so to speak, when it comes to restrictions. So easy to maintain is that kind of turnover of capital improvements that we'd have to do. Easy to evict is that most states allow a turnover in 30 days for non-payment. Probably one of the strongest lease provisions we have in commercial real estate is in a self-storage lease. The first paragraph says that the owner has the right to lien the occupant's belongings in the event of non-payment for 30 days. And so we publish notices, and people are cycled out of there pretty fast if they're not paying. So we do our auctions, I believe, on the first Thursdays of every month, and we basically are just constantly turning over delinquencies, which is great. Comparing it to multifamily, I think we get a very similar length of stay. So our tenants on the portfolio, our average is about 48 months. So we do get longevity, but we also get the flexibility of a 30-day lease. So our tenants sign one lease, 30 days, and then we have the right to adjust that lease every 30 days. So when a tenant moves in, they put all their stuff in a storage unit. Typically what we do, depending on where we are in the rents, we can raise their rents within 30 days and keep a great hedge against inflation. So we can keep up with that CPI better than most asset class types. Multifamily is pretty close to that with a 1-year lease typically. But we can really drive up that rent and keep up with inflation as the market starts changing on us and costs start going up. So it's really interesting dynamic in self storage.
So I hate to harp on this, but I'm very curious, and that is, okay, these are great reasons you outline this, but was there up front when you guys started Spartan, when you and your business partner got started in the business? Had you dabbled in other areas? Clearly, you got involved in residential, single family residential flipping, some development. But had you dabbled in other areas and then were exposed? Or are you just big research guys decided, hey, we're going to sort of take a look at everything that's available and try to identify the optimal asset type for us and what we're looking for?
That's exactly what we did. We stood down the company for, I believe, 4 months, and we said, okay, we're going to sunset these residential developments, sell them off, and we're going to focus on, okay, is it multifamily? Is it industrial? Is it office? Is it RV parks? Is it self-storage? What makes the most sense? What do we like? So we did a ton of research, and actually at the time, Scott's wife was working for us, and she has a background in intelligence. So she actually worked for one of the 3-letter agencies in DC. And, we did a lot of research on how is self-storage doing? How does it work? What trends can we kind of pull from? And so it just did incredibly well. I will say the first time we got into a self-storage development was actually through another operator. So we
Mm.
invested in another syndicator's opportunity, and we learned a ton from that, mostly about what not to do. It was kind of funny. We invested in that project, and then ultimately had one of our own projects. It was a ground up development that we invested in, and then we did our first ground up development. We actually opened before that person did, many years later. So, we have a core competency in development, and having somebody to sort of be there as a mentor was really helpful. We also did a ton of research, and we went to all of the different self storage trade shows and went on a full educational blitz to learn as much as we could about the asset class before we really dove in.
Love it. Well, thank you for allowing me to badger you a little bit there and dig a
No, it
little
was
bit more
good.
out.
I
I
like it. I
appreciate it.
like it. Yeah.
So I want to move the conversation forward a little bit, and we've talked about all the benefits of investing in self storage and being a part of the self storage world. Talk to us a little bit about the reasons or the challenges that you face when investing in self storage.
Yeah, a lot of challenges are with finding the right opportunities. So you really have to have your data scientists, your team ready to find that demand and that supply gap and really find markets where there's rent growth opportunity and size up a particular location. People ask like, "Oh, how's self-storage in Seattle or how's self-storage in Houston?" And it's kind of a bad question because you really have to focus on the hyper local market because people don't drive an hour to go to a good storage facility. They kind of look at price and location, and so you have to really kind of understand the demand in the immediate market for self storage, and that's 100% data driven and a little bit of experience to kind of match up, occupancy data, et cetera. So I would say finding a property, especially if you're doing ground up development, you really have to know your numbers because if you don't, you could build something, have a huge debt payment, and not be able to fill it up. That's a big threat. So I'd say that's number one. Number two, REITs and other competition, small operators, syndicators are pouring into the space at a record rate. And there's really not a lot of self storage to buy. So, if you think about multifamily, I mean, how many multifamily buildings do you think there are in the United States? Probably well over a million. There's 55,000 self storage facilities in the United
Mm.
States, and probably 30,000 of them you don't even want to buy because they're like 10 units in the middle of nowhere. So the reality is there's not a lot of product that trades, and there's a lot of competition for the assets. So you don't hear about self storage as much because it's just such a smaller pond that we play in.
Hmm.
Multifamily, you see multifamily everywhere because there's a lot of it, and so there's a lot of it to buy, and there's a lot of it that trades. Self storage just doesn't have that huge market and scalability. And I would say the third thing that is challenging about self storage is it's not complicated, but it's different. And you can overdo it or you can underdo it. Or people think that they can just unman everything. And, they heard another company that just has unmanned properties and they use technology and everything went great. But there's a lot of kind of half truths to how you really need to set up your operations to be successful. There's a lot of companies out there that just use third party property management. Oh, we'll just have this other property management company manage it for me, and it'll be great. But there's always a misalignment of interests. So I think kind of understanding the game and how it is different. It's simple, but it's different. I think is really important. I think a lot of eye opening, moments that people have when they first get into the space. So you really want to be partnered with somebody who has their arms around the industry and is really active in the self storage space.
Love it. So, give us, well, let me ask this question. When did you formalize Spartan? When did you guys actually come together and formalize the company?
2013.
Okay. So, give us a brief synopsis of where your company is at today. I've given the listeners a little bit of a heads up about
Yeah.
the size of your company, but maybe you can give us a sense of what Spartan Investment Group focuses on today and what you guys have accomplished in the form of acquisitions thus far.
Yeah. So we just broke 100 employees, full-time employees, which is great. We have our own construction company within Spartan that focuses on building our units and fixing up our properties. So we have general contractors on staff, as an example, and field engineers, project executives, the whole value chain there. We have our own property management company that manages all of our assets exclusively, and that's Free Up Storage. So we created our own national brand that we can put on all of our own properties, and we have our whole operations team. We have corporate finance, our own accounting, and our own internal corporate finance and acquisitions team. 5 people that go out and they're looking for properties on a regular basis. They're networking with the top brokers. They're looking at off-market deals. They're looking at on-market deals. They're looking at raw land development, et cetera. And then we have a whole IR team. So we have, I believe, I'm probably going to misrepresent this, but we have about 6 people on our IR team now. So everything from taking care of our existing investors to finding new investors, and then kind of in the middle where people have found us and want more information, want to talk to a team member about our company. And then we also have capital markets. So, all these properties require a lot of different debt. And that's one thing that's challenging, I think, in any asset class is securing debt. And so we have an entire team that focuses on securing our debt. So a capital markets VP that focuses on relationships with banks, closing loans, et cetera. And so that's kind of the breakdown of our 100 people that are across 11 states. We have 3 million, just over 3 million square feet of self-storage, and that's about 25,000 doors of storage, and just north of $500 million in AUM under management.
So when you set out to build a large company early on with you and your co-founder, you guys are well on your way to accomplishing that goal. Where do you guys see Spartan Investment Group going in the future? What are you guys looking to accomplish long term? What does this look like for you?
Yeah, so really great question and very timely. We do a strategic plan every 3 years. And so our strategic planning cycle ends at the end of 2022. And your listeners and yourself can download our strategic plan. It's on our website at spartan-investors.com. You can go on, you can download our plan, and we lay out our 3 main objectives for the 3 years that we have and our key performance indicators and getting there. And that planning cycle ends at the end of 2022. And our goal was to acquire 250 million, launch externally facing services, and really just set up the infrastructure that is Spartan to really thrive and grow. And then all the little granular things that fall below that. We're now kind of in a new planning cycle. So obviously we hit our goals of our strategic plan way earlier than anticipated by getting, $500 million under management. And now we're going through our next 3-year goal. And that concludes with a $5 billion portfolio of self-storage, and really kind of setting up a company that can provide construction services or general contractor services for other operators. It also looks at, kind of really growing into another asset class over time, and really just building out our storage platform and having over 300 locations. So that planning is in process. So that's kind of where we're going next. And our new strategic plan will be released at the end of the year.
Love it. And do you have a sense of a timeline of when you look to achieve your 5 billion mark?
3 years. So 2020, I guess that'd be 2025.
Great. So let's talk. I appreciate it. I mean, it's incredible growth that you guys have accomplished. I actually, as in doing my research for our interview today, I was browsing your website and saw that there was the goal up there of 250 million, and then noticed, roughly $500 million already. So congratulations on your success. So that's awesome.
Thank you. Yeah, last year was crazy. We actually picked up about just shy of 300 million last year alone. So it's amazing what you can do when you lay out your plan and just kind of stick to it. And, a lot of credit goes to Scott for keeping us on the straight and narrow for focus and in leadership. So.
Well, I do want to touch on that real quick. You guys have scaled your business very quickly. I mean, well, you started in 2013, but, there was a ramp up period to really getting clear on what you guys wanted to accomplish. But it feels like, and just talking with you and the way you guys present yourself at different conferences and, through promotional items, that this is a very corporate type of environment. And it seems intentionally corporate. Tell us a little bit about that mentality versus what you often see in the syndication space where you have sort of entrepreneurs that are coming together and forming loose relationships or joint ventures on particular deals. But you guys have chosen to be very specific about how you structure this and how you move the business forward. In general, just talk to us about sort of the mentality of the corporate environment, the corporate structure. I see the Spartan creed on your background there. So, I mean, you guys have really put a lot of effort into building a machine that's going to help you get to the $5 billion portfolio. What could you share with our listeners that may have aspirations to accomplish what you guys are accomplishing? And how can you, what ideas could you share with them that would be helpful?
Yeah, that last part that you just said was a really good disclaimer. If you desire this, what would you do, and how would you get there? I think you have to make that decision first. Do you desire this, or do you just want to, and there's nothing wrong with it, doing a couple of deals a year, or putting together some JVs, or working with another GP or a KP to make your apartment deal go. There's nothing wrong with that. That's totally fine. We just kind of looked at it a little bit differently. We wanted to grow a business that something bigger than ourselves. We wanted to build a company with that adheres to our mission, which is to improve the lives of our employees, both personally and professionally. And we wanted to set up a culture and a company that did that. And so by leading with our values and working through kind of building an infrastructure that supports that, you really have to kind of corporatize it in a way. And so if somebody was thinking about it, they were just completely at ground level. The number one thing I would do is I would write a strategic plan. And again, you can just rip off our template on our website, and really just lay out where you want to go in your plan. And then I would adapt some type of operating system like Traction or EOS. Get somebody like a strategic coach to help you implement and put together infrastructure that helps you grow. And I would be, really focused on reading books. And there's a plethora of books that you can read, like Scaling Up, like Scaling Compensation. I could keep going. There's a ton of things. No Rules of Rules by Netflix. There's just tons of books that give corporate culture examples. But really, there's not a silver bullet answer. You kind of got to make it what you want it to be and not what some book tells you it should be, but using aspects of what you learn to kind of, I like that. I think that would work in our culture or what we're trying to build, I think is really important. And I think having a mission, vision, values and putting it up on the wall and talking about it and reinforcing it is something that really kind of helps homogenize what you're doing and starts creating a culture. The other thing too, I think is kind of an unpopular thing right now. Everybody's talking about, working remotely and not coming to the office, and is this necessary, and I can be more efficient at home. I will be the first to say that our growth has come from getting a physical office space. So we opened up our office, I believe, in 2018 in Golden, a 1,500 square foot office. We outgrew it in like 3 months. We had to break the lease. And then we went to a 4,000 square foot office. Again, outgrew it, not in a little bit. Now we've been searching heavily, but now we have a new space. We also have an office where I'm at today in Seattle. I think having the physical presence with each other has helped fuel our growth, and really helped build a culture, because it's hard to build a culture when you're spread all over the country and you don't get to interact. And then there's all these little moments where people are talking and they overhear something that, I didn't know that. I didn't realize that. Hey, and can I bend your ear on that? Or can we just talk about this for a second, versus like scheduling a minute on Zoom and everybody's booked to the gills and you can't get a minute in, and there's no time for overhearing these types of things and growing and really, kind of changing things. I think that's overlooked. And I think that's one of the big parts of it is having that physical space. And it's not for everybody. I realize that it's more expensive to have employees based in Seattle and more expensive than having employees based in Denver and having people come in. I understand that, but I think people look at the expense savings and not the revenue growth opportunities that are being missed.
Yeah, love it. Well, and I think it comes down to the founders and the executive team and how they're going to lead out in that regard. I've had an opportunity to interview a few different guests who have talked about this topic during our interviews. and one group has acquired $1 billion in the last 3 years, and they're almost all remote. And then
Yeah.
another
Yeah.
group who is adamant, just like you, that their growth has stemmed from the fact that they purchased a physical office, and they're all there 9 to 5 getting after it on a daily basis. So I can see both perspectives for sure.
I think it's a lot more fun, for the most part too. And we do a hybrid, so Mondays and Fridays are work from home if you want. But having the space is good. What's cool too is we've kind of taken advantage of the space, and now we do investor meetups in person here,
Mm.
and then we also broadcast it live to Zoom at the same time. So you get the in-person audience that wants the high touch, and you get the webinar presence as well.
That's a great idea. So
Yeah.
I want to shift gears just slightly here. What percentage of your acquisitions have been new development versus existing value add plays?
New developments are less than 10%. I'd probably
Oh,
say
interesting.
less than 5%. They take a lot of bandwidth and they take a lot of time. Now, the existing purchases that we make, I would probably say 50% of them have an expansion component. So,
Mm.
we buy a 700 unit facility and we add on 400 units or 300 units, something like that. Most of our acquisitions are like that, but very rare are we doing like greenfield developments where we're literally taking it trees to keys and going through the entire entitlement process, soup to nuts. I think most of our stuff is existing facilities that have some kind of expansion play to them.
And so, considering that, at a very high level, what are the metrics that you're looking for in a particular market? Just high level metrics. Don't want to get too deep, but give our listeners some guidance on how you're identifying markets and what you should be focusing on.
The number one is rent growth. We have to make sure that we can get rent growth in a market. So we will look at two different factors for that. One, population growth kind of fuels that, and then we look at income levels, and as a percentage of how much people can afford self storage, we look at where they're at paying on the average today versus where the average household incomes are, and where how much we can grow revenue. We look at factors like job growth, what employment anchors are in the area, and then we have to look at hyper locally at the competition. We have to see,
Mm.
are our competitors full? How many facilities are being built in the pipeline? We go and physically look at every single property, every single one of our competitors, and we mystery shop every single one. We pull lots of data online. So we're doing a ton of research to kind of validate our underwriting. But one thing that we don't really do at Spartan, we don't plan on much market rent growth. So we're not thinking that the market is going to grow, 9 to 12% like some of the REITs. We'll look at maybe over a 5-year hold, maybe 6 to 7% total growth for the entire 5-year hold. So we're not even really banking on much rent growth. We like those properties where we just bought one, for example, in our fund, where the property is 51% on average below market rents.
Hmm.
There's over 100,000 square feet of demand, and the mom and pops that own this property have owned it forever, and they haven't raised the rent on some of the tenants since the 90s. So when you think about, never mind inflation or recent craziness, they haven't raised rents in over 30 years. And so we love those types of properties. And then we go around and mystery shop and realize we have the nicest property in the market. Everybody else is 99, 100% full. We're way below market rents, and there's a surplus of demand because there's jobs and homes coming to the area. That's the recipe for an outstanding opportunity to literally, on 45 days into takeover, we've got the rents increasing, sometimes 50 to 90% upon takeover. So that's kind of the sweet spot that we look for. And we like the tertiary markets. And I know tertiary is
Hmm.
kind of like, what does that mean, right? It means a lot of different
Yeah.
things to a lot of different people. So I like to say within 90 minutes of a major airport. So 90 minutes within Atlanta or 90 minutes within Dallas, Fort Worth, et cetera, are generally where we're playing. We're not looking at a 30-unit facility in the middle of nowhere. That's
Got it.
still tertiary, but so we like to have that. We like the bedroom communities, like around DFW, for example, Dallas, Fort Worth. We like where population is trending and going.
And I noticed that you have acquired facilities in many markets across the country. It's not like you're regionally based, so to say. At least it didn't seem that based upon what I was able to gather from what you had publicly available. Well, let me ask you that: is that accurate? I mean, you guys are spread out fairly wide across the country. Is that correct?
Yeah, so we took the 4,000 metropolitan statistical areas in the United States and we put all of our ingredients for great self-storage markets into that. And we boiled it down to 150 markets across the United States. And we look in those markets only. So while we are kind of geographically spread out, we do have regional managers, district managers, area managers, and then store managers in all the markets that we're in. We also have our construction company that is constantly traveling to different locations and employing field engineers for each of our expansion projects. So we're all over the place, but we're also very focused on where we'll go
Mm-hmm.
for doing a specific property. For example, not to pick on Michigan, but I'm from there, so I'll pick on it a little bit. We don't look in Michigan because it's generally net migrate. It's you're losing population. We don't look in Detroit. It's an exciting place, but there's not a lot of population growth going there. It's losing population still. Or like Ohio, I can really pick on Ohio being from Michigan, but we don't like any of those markets with the exception of Columbus. Because Columbus has growth. So
Mm.
we'll look in Columbus, but we won't look in Cleveland or Toledo or Akron or any of the other markets in that because we make broad brush strokes for the trending markets, but then we go hyper local and make sure that the 5 mile market and the 3 mile market makes sense.
And so you mentioned, that you have a well built out team, but it hasn't always been that way. And so, what are the challenges in operating and managing projects and facilities across such a broad scope of the United States?
Oh, we still have those challenges. We're still every day we're working on it. Every day we have store managers quit, resign, walk off the job, and that's one of the challenges of being a sponsor, right? You're going to have employment problems. You're going to have what you think is a great hire turn into a bad hire, and that's just the reality of the situation. You just have to have a team that has the grit to work through it. You got to be ready to get knocked down and get right back up, and you got to just be constantly ready for disappointment. We've had a rash of break-ins lately,
Mm.
and it's just something that you've got to deal with, and it's something you got to fight through, and know that it's not going to be easy. I think a lot of people think, oh, you just throw a manager at it and it's going to be fine, but you've got to train them. You've got to, everybody needs sales training. Everybody needs, specific technical training, and you've got to be set up to do that. And especially if you're going to run the property ops side of the equation. But even if you manage, even if you hire third party management, you've got to be ready to manage the manager, right? So
Hmm.
just because they're the manager in the market and responsible for hiring the employee now, you've still got to keep tabs on them to make sure that they're doing an honest effort to make the best of your facility and its performance. So, some of the challenges are overcome by good recruiting, good training, and just having good people at corporate that can then find the best people in the field.
In my understanding, it's very common in the multifamily space for us to hire third-party professional management, regional management in place in order to overcome sort of a geographic stretch. Whereas my understanding in the self storage space is that it can be problematic to hire third party management. Um, and there's maybe some conflicting interests that go on with large property managers that may be interested in helping you with your facility.
Yeah, three things, three misalignments of interest in general. One, property management for the big REITs is just an acquisition strategy. They want to buy your property, so that's why they want to be in there. Number two, they're misaligned because they care about a percentage of revenue. You care about net profit, so there's a misalignment there. And I would say the third one is they've got multiple stores in every market, so they're not going to
Mm.
be pushing a particular uh, client or tenant to you. They might match it up with the better store, right? And that might be a bad thing. I guess I'll add four or five things that I don't like. Ask me how I really feel. So the other thing is when COVID hit, one of the big property management companies, they just changed their algorithm on pricing and cut pricing by 50% across the United States. And you had no choice over that. So like if you were charging $100 a month for a 10 by 10, now you're getting 50. It doesn't matter how full you were, doesn't matter how successful or how much demand your property had. Now you're getting 50% less uh, rent, and you really don't have any control over that, which is alarming, right? And and I think that's really just kind of the major issues that you kind of run into is you're kind of at their mercy. And the fifth reason is, they'll say, oh, our fees are standard in self storage is 6%. 6% of gross revenue is the kind of the standard that the industry charges, but it's 6%. Oh, you want marketing? Oh, well, that's more. Oh, you want a call center? That's more. Oh, you want us to, answer the phone when the phone rings? I'm exaggerating, but
Sure.
there's a lot of add-on expenses that people don't realize that suddenly your property management's really like 10%. And so, as a sponsor, we charge 6% for property management, but we include a lot more things inside of that 6% than most of the third-party externals do. So they can really run up a bill. Like one big one is we make a lot of money on tenant insurance. And there's some property management companies that do not share the tenant insurance revenue with you, which could be millions depending on how much your how big your facilities are, how big your portfolio is. So there's a lot of I gotchas in there that you just have to be ready for.
And so, for a newer sponsor, I'm assuming that you guys haven't always had your own in-house property management. And
We
so,
have.
what did you
We
have
did.
from day
Yeah,
one?
we started it that way. Yep.
All right. Interesting. And so, if you were advising a new sponsor looking to take down their first facility, would you advise them to implement in-house property management?
Depends. I would make sure that you have somebody who is highly skilled in self storage or has experience with it, or has some kind of operational background on your team very early on, and you just got to be ready to deal with it. Sometimes, our first property, we had this property in Conifer, Colorado, just right Aspen Park. It's right outside of Denver, and it's up in the mountains. It's 8,500 feet, and the power would go off on this facility all the time, right? And it was unmanned. So that was our first operating facility, and all the time the gate would get stuck. A tenant would go in there, and it's a fully gated facility, and the power would go out. So then the tenant would be trapped inside the property. So, and it would happen at the worst times. So what are you going to do about it? Right? How are you going to help that customer out? It's kind of an emergency situation. They're literally trapped inside your property. So you just have to be ready for stuff like that, and you have to have a stomach for it. And a lot of people might go, I just don't have that stomach for something like that. A lot of issues that people run into is like on that property, the revenue wasn't substantial enough to really support a third party, and a third party is usually going to charge you 6% or a minimum per month, or they won't take the deal. So for that property management on that property would have killed the financials, and we wouldn't have been able to have a property management company on it. So a lot of little intricacies, but you just have to be ready to deal with property management, which is probably the least attractive part of the business.
Yeah, yeah, I can imagine. Well, you have been gracious with your time thus far. I want to start working towards winding down here. I've got one question for you as it relates to just what's going on in the market today. Just for our listeners, we're recording the end of July here. We're about to have another Fed meeting that will probably announce at least a 75-point rate hike, possibly a full point. So what advice would you have for other lead sponsors to take advantage of the coming economic shift? Like what one piece of advice could you give to someone who's in the space to help them navigate what we might be experiencing moving forward?
So I would be, I don't know, probably, I don't know, maybe this isn't the best advice, but marry the property, date the interest rate. I think there's going to be really good properties to buy right now. I would just write in conservatism on the interest rate, and I would try to get it so your exit fee is zero or low, because I think that in a year or so, maybe longer, that interest rate's going to go back down, and we're going to see the opportunity to refinance and really reward those who stayed in the game and bought good properties during this time versus those that kind of froze up. I mean, you can see Blackstone is being, touted like a $30 billion buying spree that they're getting ready to pounce. China is starting to buy more housing. They're getting ready to come back into the market because they're so fed up with all the things that happened during COVID in China. And so I think you're going to see a surge of a buying opportunity. And when the Fed keeps cranking the interest rates, and eventually it has to go back down, the underlying interest rates are going to compress cap rates again. And I think those that have bought the properties and can exit those through a refinance, I think, or just restructure their loans, it's going to be a really great opportunity. But until then, I would be very conservative. Just be upfront with your investors that hey, we're in this high interest rate environment, and these things aren't going to cash flow like they did 6 months ago. And but hang on, because there's a bigger pie at the end of the at the end of the road that there's more to achieve. So yeah, I would say marry the property, date the interest rate.
Love it. What's the biggest challenge that you're facing right now in your business that we could all learn from?
Financing. All the banks are just slamming on the brakes. Everybody's taking forever to refinance properties. They're lowering the amortization schedules. They're increasing the interest rates. They're reducing proceeds. Banks are shuttering capital improvements, for storage. Financing is a big deal, and I would say I'm thankful that we have a team that works on that day in and day out, because that's a big part of your business that you've got to be ready to take advantage of. So that's really kind of been our woes over the last few months, and probably a lot of people as well, with just kind of where we're at in the market.
And I know you have a whole team that's on the IR side of things. You don't acquire, a $500 million in the last couple of years without a fair amount of equity flowing into your company. Outside of the referrals, which, that's obviously the main source for most of us as it relates to equity referrals from past investors. But outside of referrals from past investors, what's the best way that you guys have found to attract new investors to your business?
Yeah, so we've raised about 250 million to date. And I would say one philosophical way to look at it is the 80-20 rule, which somebody recently taught me, but I kind of realized that it's applicable to pretty much everybody. That 20% of your time and effort produces 80% of your results. So start to measure your efforts and what really makes an impact. Does posting on every social platform every day bring you investors, or is it trying to find an IRA company that will allow you to speak at their event and get in front of people that have liquidity, right? So do the 20% things that do 80% of your results. And I think you'll also notice that applies to your capital, right? So if you look at all the capital you've ever raised, probably 80% of it comes from 20% of your investors. And, I know we have a lot of 50K investors, 50K investors, 50K investors, but there's a couple of $10 million, $5 million households. And, when you add it all up, a majority of the capital comes from the bigger check writers. And so ask yourself, where did you meet them? How did you acquire them? Where were they playing when you decided to, what event did you meet them at? Maybe you got to double down on that event, or maybe you got to double down on that meetup. Or maybe you need to do more of what attracted that capital to your business. So that might be different things for different operators. But for us, I would probably say for a long time, it was personal relationships, airline pilots, military vets that knew Scott, et cetera, people that Ben worked with in New York City. But I would say over time, it's transitioned a lot to meetups and conferences, really is what's driving it.
Love it. Great answer. Yeah. All right. Well, Ryan, this has been great. I appreciate you spending the time that you have with us. We've gone a little bit over. I appreciate you staying a little bit longer. The final question I've got for you here is, what's the best way for our listeners to connect with you, learn more about Spartan Investment Group and what you guys have going on?
Yeah, our website is spartan-investors.com. My email is Ryan at Spartan-investors.com. You can catch me on LinkedIn as well. And yeah,
Okay, awesome.
any social platform.
We'll have that in the show notes. So if you've enjoyed our conversation with Ryan today and you want to connect with Ryan and his team, reach out to him. Go down to the show notes right now. Click on that link and connect with Ryan and Spartan Investment Group. Ryan, a pleasure to have you on. Thank you for spending the time with us, and I look forward to connecting with you down the road.
Appreciate it, David. Thank you.